Hello and welcome. We are filming this update just after the Bank of England's September Monetary Policy Committee meeting, where the bank decided to hold off raising interest rates, keeping them at 5.25%. The commentary available so far implies the bank is pausing to assess the impact of over 5%, that's 500 basis points, of tightening since December 2021, when rates were first raised from a historic COVID pandemic low of 0.1%. The bank had some good news on the CPI front this week, with core inflation, that's inflation excluding volatile items, falling in August to 6.2% from 6.9% in July, and a high of 7.1% in May. Headline inflation fell from 6.8% in July to 6.7%, and this compares with a peak of 11.1% in October last year. Now, while a slowing in price rises is welcome, inflation still is a long way above the Bank of England's 2% target. And there are two other important pieces of information that have been reported in the past week or so. The first is average weekly earnings growth, which has risen to 8.5% in August from 8.4% in July. The Bank of England made reference to this in their policy statement, questioning whether actual inflation in wages is as high as that. They are on a wait-and-see policy stance, which explains the split of 5-4, with 5 committee members wanting to wait and 4 wanting to hike by another 25 basis points. Still, rising wages growth is closely associated with services inflation. The Bank of England will need to tread very carefully. Secondly, house prices have been recorded at the Land Registry to have not yet fallen on a year-ago basis, which has confounded some forecasters' expectations. Now, house prices are an important barometer of household expectations for inflation. And while consumer surveys of inflation expectations have definitely come down over the past year, they still remain above long-term averages. Well, this month the UK bond market is doing comparatively better than the US and European bond markets, as those markets had already shown better news on the inflation front. The UK is playing catch-up in this regard. The bond markets are no longer pricing the need for much higher cash rates in the UK. Stock markets are enjoying modest positive returns as economic data is tending to confirm a soft landing, and of course helped by the growing consensus that most central banks are looking to pause their tightening programs. Thanks for watching.